For those of you that do not know me, I am Kathy Neifeld. I'm one of the partners with Agency One. We've got some new folks that are joining us. And for the folks that don't know us, welcome and thank you for dialing in. Agency One is a full service brokerage general agency that is located in Rockville, Maryland. And we focus on life insurance, linked benefits, and annuities. We have a national footprint. We work with advisors all over the United States. And periodically we host webinars like the one that you have dialed into today. Today we're going to be talking about legacy planning for qualified plans and annuities. And we are thrilled to have joining us Carly Brooks and Wayne Baldwin from John Hancock. Our featured speaker is Carly Brooks, and Carly is the head of Advanced Markets Group for the U.S. individual life operations of John Hancock. In her current position, she manages the Advanced Markets team and helps drive strategic growth initiatives by providing case consultation, technical expertise, and marketing support to field personnel, producers, and financial professionals in the areas of estate planning, tax, and business planning. Carly is an accomplished public speaker, frequently speaking at industry events and conferences, and is also an experienced legal writer. Joining her at the beginning of the presentation is our regional VP, Wayne Baldwin. Wayne holds a CLU and a Fellow of Life Insurance Management Institution designations and is a past MDRT qualifier. Wayne, I think, has the longest tenure with John Hancock and Manulife and has performed various roles in marketing support, specializing in estate and business planning. He takes an active part in leadership of a number of industry associations and is based out of the Pittsburgh area. Wayne asked me if I would give him the floor for a few minutes to talk about what's happening with John Hancock, because he had some important announcements. So I am going to turn this over to Wayne, and then Wayne is going to turn this over to Carly. One additional thing before I hand it off to Wayne, when Carly starts her presentation, if you have any questions, please type them into the Q&A or the chat, and Carly will address them either as she's doing the presentation, or there's going to be a natural break, between qualified accounts and annuities, and she'll address them during that time. So without further ado, Wayne, take it away.
Kathy, thank you. Thanks for everybody joining us. And Agency One, thanks for the opportunity. We had a great year with you guys last year. And for those on the call that did business with John Hancock, thank you very much. For those that haven't, what's up with that? No, I'm kidding. After today, I think you probably will do more business, or you'll start doing business with us. I just want to give you a couple product updates. One of our flagship products, Protection UL and Survivorship Protection UL, we had 2 rate increases last year by 50 basis points to 4.85 is the crediting rate. And now March 1st, we're adding another 10% increase to 4.95. So the crediting rate on that product, that's been one of our flagship products since 2011. And I'm happy to say and proud to say that we're not only, that's not just for new business, anybody that bought that series of product since 2011 is going to enjoy those increases, the latest starting March 1st. So in 12 months, we've raised the crediting rate by 60 basis points. All of that really is due to the alternative long duration assets, the equities that are about 45% of the portfolio backing that product. These interest rates that we're seeing in the marketplace right now have not had that much of an effect or any at this point. It's a little too early because the rollover of those assets is every 10 to 15 years. But $6 billion in cash value, that's the in-force, will enjoy these increases. One of our other flagship products, Protection IUL, towards the end of this month, we're going to push out the guarantees an additional 2 to 3 years. So I wanted to let you know that. Protection VUL, individual product. That's our product that's guaranteed to 100. We had some pretty substantial improvements in the pricing on that, not only on annual premium, but also on short pays and dump ins. So, and then don't forget vitality on that product. If you put vitality on that product and they participate and reach silver, gold, platinum, whatever, it will drive down the guaranteed premium. So whatever the premium is, if you participate one time, it'll drive the premium down slightly, and that will be your premium, the client's premium, all the way to age 100, guaranteed. It will not revert back to where they started. So that's a biggie. The other is foreign nationals. We've become a real player in foreign nationals over the last, especially 2 years, I would say. We've broadened the scope of that. Each case is different. I'm not going to go through the parameters, and every month it's changing favorably, and we're expanding the opportunities there. So if you have a foreign national case, let Kathy or Gonzalo or your team at Agency One know about it. And then last, the vitality bonus that we're paying on non-variable business, it was 10%. We're going to increase it to 12%. So what 7% will be, you'll receive that at registration when the client, when they elect it, 7% if they elect to have that on their policy, and then an additional 5% once they register. And we've beefed up the team that will help these people register. So if there's any questions on that, you can email me on that one, and I'll help you through it. So that's a quick update of what's going on. It's all good. Hancock had a great year last year, and we're looking forward to another good one this year. So, and the real reason you're on the call right now is Carly Brooks. Carly, you're up.
Great. Thank you so much, Wayne. And thank you, Kathy and Gonzalo and Agency One for inviting me to come speak with you this afternoon. I appreciate everyone taking the time out of your busy days. And hopefully what we'll talk about today is going to give you some ideas as you're thinking about working with some of those high net worth clients and thinking about the types of assets that they own and what those assets are going to be utilized for. So when we think about qualified plans and annuities in particular, and what I think of as traditional retirement assets, those can be very effective components of a client's retirement plan. Many of our clients have qualified plans through their employers, and I would include IRAs in that overarching discussion. And deferred annuities as well can both be really tax advantage ways to have supplemental retirement income in those retirement years. But when we think about retirement planning and what that means and what that looks like, it becomes a different conversation when you think about the different risks that clients face in their retirement years. And then beyond, where if you have a high net worth client that maybe owns certain types of assets that they don't need for traditional retirement income needs, but are now intending to leave those assets to their children or to their loved ones as inheritance, we start to think about an asset that is no longer needed for retirement. By nature becomes what I call a legacy asset. And qualified plans and annuities are very interesting types of assets that, while great for retirement planning, are among the worst assets that you can leave for legacy planning purposes. And so today I want to talk a little bit about some of the changes that have happened legislatively that impact these plans and where we're seeing some of the opportunities for clients and planning opportunities in the high net worth space. So before I jump into some of that content, I just want to take one quick step back and just talk a little bit about what we're seeing in general resonating with high net worth clients. And so I get this question at almost every meeting I do, every presentation that I give, and that's what's resonating. What are you talking about? And so I think it's helpful just to sort of step back and reframe this. And so when we think about what I see in advanced markets, it's traditional tax planning and liquidity needs. High net worth clients are going to continue to need life insurance for some of those protection needs to pay for estate taxes, which we know are typically due 9 months after death. But with exemptions where they are today at $12.9 million, we're seeing the highest exemptions in history. I get asked the question all the time, will the exemption sunset at the end of 2025? My crystal ball is just as clear as yours, but I'm of the mindset that I do think we'll see that exemption sunset in a couple of short years. And so we're talking with clients about how to move forward with some of those estate tax funding needs. And the good news is a lot of clients have available exemptions that they can use to help fund those needs. I will say, though, that within advanced markets, our team has a lot of expertise on trust funding and trust financing, and we probably spend half of our time thinking about creative ways to fund large life insurance premiums inside of trusts. So that's sort of bucket number one that we spend a lot of time talking about. The second thing I think that's really important, though, is non-estate tax planning needs. So these are traditional liquidity needs beyond estate taxes. Things like estate equalization, we see these kinds of cases all the time. I was working on one last week where the client was a business owner and gifted their exemption to their son who was active in the business and had other children not active. Fairly straightforward, but I think those types of planning needs continue to be really important. Growing concerns around things like long-term care. I know many of you have probably heard about the state-funded long-term care in Washington state, and 12 or so other states are exploring similar types of state-funded programs. I think that just drives home that there's a real need to offset some of that Medicaid spending, and states are thinking about long-term care needs. And so I think clients are maybe thinking and hearing more about some of these opportunities. So those kinds of conversations are resonating. And then this last bullet that I put here, what I call an enhanced legacy to heirs or a protective inheritance. So combining trust planning with life insurance needs can really help to enhance the overall legacy that's left to clients in a really tax efficient manner. And now you have the trust terms that help to dictate where those funds are going to go. And as a financial advisor or financial planner, the funds inside of that trust can now create sort of this automatic link to the next generation where you have additional AUM inside of the trust that can be used for different planning needs. But the number one thing that I think I'm hearing that we don't talk enough about are wealth transfer opportunities in conjunction with income tax efficiency. So income taxes are, I think, top of mind for virtually every client that I work with and case that I see. And so when you think about where income taxes are today with the top rate of 37%, those are actually going to start to increase for some of our high net worth clients at the end of 2025. You'll remember that we talk a lot about the exemption sunsetting, but virtually every other provision in the Tax Cuts and Jobs Act is slated to sunset in just a couple of short years. So thinking about tax diversification, the internal rate of return on a life insurance death benefit, and then offsetting income taxes on assets that don't receive a step up in basis is going to continue to become more and more important. So that's what I want to talk a little bit about today, is how to optimize those assets that are, like I said, very efficient from a tax deferral perspective for income and retirement planning, but terrible for legacy planning and wealth accumulation purposes. And so things like that are your qualified plans, 401ks, IRAs, and then we also talk a little bit about assets that are held in irrevocable trust. So I won't talk as much about that today, but annuities and IRAs are two things that really come up here. And so that's what we'll focus mostly on this afternoon. And qualified plans in particular, I'm sure many of you are familiar with or have heard about the Secure Act and Secure Act 2.0, which just passed earlier this year. So those are really where I think we're seeing a lot of opportunities for clients as we start to plan ahead. So I do want to just spend just a minute as we talk about optimizing qualified plans to talk a little bit about Secure Act. And so some of this may be a refresher for some of you, but if you haven't been following the Secure Act is basically two pieces of legislation that we saw passed over the last couple of years. And so Secure 1.0, as I'll call it, was signed into law at the end of 2019. And a very interesting thing I think happened with Secure 1.0, in some ways it feels like we've been talking about this for a number of years now because we have been. But you'll remember early 2020, I think we all remember what happened then with COVID and many other competing planning needs and priorities. Secure Act kind of was pushed to the back burner, I think, a little bit, or forgotten about, less talked about back in 2020. And with Secure Act 2.0, which really was intended to make some technical corrections and changes to the original act, now we started talking more and more about really what was in Secure Act, the original Secure Act. So Secure Act 1.0, as I'll call it, was a major overhaul to retirement planning that affected IRAs and defined contribution plans like 401ks. And at the end of the day, the Secure Act was a revenue raising provision. And so you may say, a couple of things happened with Secure Act. It was bipartisan legislation. And that was really important, where there was this sort of a mutual need to enhance the general public's ability to save for retirement. But to fund that and have this be the revenue raising provision it was intended to be, the biggest change that was made in Secure Act was the limit of the so-called lifetime stretch, or the stretch IRA. And so what I mean by that is, under old law, you used to be able to take an IRA leave that to the next generation, and then stretch that over the beneficiary's lifetime. And so in certain contexts, like a grandchild, for example, that would be much younger than the plan participant, now you have years, if not decades, of additional tax deferral that you benefit from. And so the stretch IRA was something that was really viewed as being abusive. And so so Secure essentially looked to rectify that. And so where we are today, or where we were post Secure 2.0, is that we saw some increases to RMD ages, originally from 70.5 to 72. That's since been increased even further. Contributions can be made later. And there were a number of really good public policy around planning for retirement within the Secure Act. But like I said, that inherited IRA piece really was the focal point and has continued to be the focal point for us, and where I see the opportunities around these conversations. So that not having the ability to stretch the IRA really does limit clients' planning opportunities and can frustrate some of those planning goals. But even one step further beyond that, where you're now having tax compound, the tax burden is compounded, where an IRA is a unique asset that doesn't receive an income tax step up in basis at death. So that full IRA is going to be income taxable at the beneficiary's tax rate. Now we're seeing clients that have really large IRAs sort of think about how can we more effectively plan with these big assets that in many cases comprise a large part of their overall estate. So what happened with Secure Act 2.0? This was passed, like I said, at the very end of last year in December of 2022 as part of a much larger spending appropriations bill, where we saw thousands of pages of text and a lot of the things within Secure Act 2.0. So if Secure Act 1 was really this wide sweeping change, Secure Act 2 is more of a subtle changes that I think helps to clarify certain issues. But I highlighted 3 things that I'm getting the most questions about around Secure Act 2.0, and some of the things that I think are really good planning opportunities. So the first is the increase in the RMD age to age 73. So starting this year, we'll see RMDs increase to age 73, and then that's actually going to be phased in. So by 2033, up to age 75, you'll start taking RMDs. And so I highlight that because that's good for people that are working longer. But if you're working with clients that are excited about the increased RMD, I would encourage you to look to see, well, what's their retirement plan? Because that to me indicates that they don't really need to start taking RMDs. They'd rather have them sit in that IRA and continue to grow. And so that could be somebody that you're maybe thinking about targeting to look at for some of these solutions that we'll talk about around IRA optimization. The second is increased charitable QCDs. And so those charitable distributions direct to charity that we see under Secure Act 2.0. And I'll walk through an example where this actually could have worked really well for a client that we worked on a case last year with, is if you have a client that's charitably inclined, you can now potentially redirect some of those charitable distributions direct to charity. And so that's really great. And where we see the life insurance opportunity there is using life insurance as a wealth replacement tool. And then the last one that I'll highlight before we move on to some of the planning ideas is this section 334. And so section 334 is a new code section that allows for distributions for long-term care payments. And so essentially what this does, and a lot of this still needs to be defined and it's not going to be phased in for a number of years, but this is just a talking point as I see it. So you have section 334 that allows you to basically take a penalty-free distribution from your IRA to pay for long-term care coverage. And so if you're under age 59 and a half, you can potentially, once this phases in, take a distribution to pay for standalone long-term care coverage. And then it's not exactly clear from the wording in the text, but we seem to think that it would apply to long-term care riders as well. But why is that important? I think, again, if you're weighing the advantages of take a distribution, a taxable distribution under 59 and a half penalty free to pay for long-term care, is that the best source of funds to do that? Maybe, maybe not. I think there's little things you have to weigh there, but it just drives home again the talking point around the long-term care planning need. So all that being said, I think the challenge with all of this is we're seeing clients have these large IRAs, particularly in the legacy planning context, and we're wanting to work to plan against that 10-year rule. So So I'll just illustrate this with just a quick example where here we see the loss of the stretch IRA. And under prior law, like I said, you could stretch an IRA over the life expectancy of a child or grandchild, and that would yield decades of tax deferral in the funds. And so as you can see from this example, a $2 million IRA inherited by a 40-year-old at 5% growth, that would have meant that you'd have distributions of $45,000 to $75,000 or $70,000 a year in distributions, which, based on that life expectancy, is relatively modest. So in those first 10 years, based on an average 40-year-old's life expectancy, at the end of 10 years, you still have 2.25 million in that tax advantaged account. And so that's a nice solution where you can see the compounded growth that's retained inside of the IRA. Now, after Secure Act, distributions from the tax-deferred account is obviously rapidly accelerated, where we're seeing income tax triggered by designated beneficiaries much sooner than what we would have seen under the stretch under prior law. And so in that same example where you have to empty that out fully by the end of year 10, that's going to be 200 to 310,000 in distributions. And what you're seeing is that long-term tax deferral that's lost. And so the beneficiary is now going to be pushed into a higher income tax bracket. And so that's challenging because you're going to see the funds received a lot more quickly for different planning purposes. And so I point this out because we're always so focused on taxation and taxes when we think about the loss of the stretch IRA. And that's really important for a lot of clients when we're thinking about the need for effective planning. But to me, the biggest loss with the loss of the stretch IRA is this frustration of clients' goals. And so where you see a client that wants to utilize this asset that they worked in many cases their entire lives to accumulate, now you're seeing it be sort of distributed in a way that may not meet what their planning objectives are. So for example, if you have a client that has spendthrift issues, now that beneficiary is receiving those funds on an accelerated basis, it drastically obviously reduces opportunities for income tax deferral, but those income tax bills may trigger income at higher rates for the beneficiaries and push those beneficiaries into the higher bracket. You lose the creditor protection. It's a loss of AUM. So that's where I think when we start to talk about legacy planning with IRAs, the conversation really should change and has already started to change. And so that's why I want to walk through two different client profiles where we're seeing success talking about IRAs. And so it's basically this idea of sort of what are your clients' options if they want to plan more efficiently. And so the one that we hear talked about a lot are Roth conversions. And I'm not going to talk a lot about Roth conversions today, but I will say a Roth conversion could make sense for certain clients. And for some planners, I find this is where the conversation stops. And so what I want to suggest is that maybe we take it one step further and look at an alternative option, which is using life insurance to help reposition and optimize the IRA or the qualified plan. And so, so with a Roth, you still have, there's probably going to be a crossover, a break-even point from an income tax and cost perspective. But you also have to keep in mind that with a Roth conversion, that 10-year distribution rule still applies. So while you're not paying income taxes on the distributions from the Roth, the full account, you're not able to retain that indefinitely under the Secure Act. And so that's where, I think when we think about holistic planning, looking at life insurance can make a lot of sense. So we'll look through two client profiles. The first is what I call a retirement backstop client. And the second is what I think of as a true legacy client. And so I'll define what both of those mean, but the backstop client is sort of this client that you might be working with. And these are both real cases, by the way, too. So the first is someone who is maybe secure in their retirement, but has some planning concerns. And so this is maybe the person that feels like they don't probably need all of their RMDs for current income, but they're concerned about outside factors that could change that. So if you have, for example, $1.5 million IRA, the client saying, I don't need to rely on this for retirement income. I'm going to take those RMDs that I'm required to take once I'm starting in a few years, and I'm going to put those basically in a side fund because I don't need them for current income, or I'll gift them to a child. But those kind of clients may be concerned about some of the other outside factors that could impact their retirement longevity. And the biggest risks that your clients face in retirement, there's many of them. So it's withdrawal rate risks, sort of living too long, dying too soon, all those different factors and things that we hear about. But the number one risk your clients face in retirement It's unquestionably the cost of long-term care. And so if you have a client that thinks they don't need their retirement for current income needs, but wants to provide a backstop against retirement income and help to protect that retirement income, that's where we can see sort of this IRA Max with long-term care story go hand in hand. And so in this example, the client wants to protect for the spouse. Maybe they want to do a little additional legacy planning for the child. But what we're suggesting here is that you could take a distribution from the IRA and purchase a $1.5 million policy here, the PUL, with a 2% long-term care rider. And so in this example, the premium on that is $38,000 a year, but it allows for the client to really plan for multiple needs. So as you can see from just looking at the case number here, the IRA value, that's $1.5 million IRA. Now we're, instead of reinvesting those RMDs at 3% in a side fund, what we're suggesting is taking the RMDs and purchasing life insurance. And that's going to get by the $1.54 million life insurance policy, the death benefit that could be received inside of a trust. So for legacy planning, if that's held inside of a trust, the IRA could be left to children or grandchildren as beneficiaries of that. And because it's a life insurance death benefit, now the client's going to be working with their financial professionals to help invest those funds. So that kind of creates this automatic tie or link to the next generation and allows for the proceeds to be distributed out as the client sees fit. The $1.5 million death benefit can also be used for the surviving spouse. We also see this sometimes where the surviving spouse can roll the remaining IRA balance and wait to take RMDs until her age 72, or under the new rules, age 75. And the spouse could also convert the IRA to a Roth and then use the proceeds on the insurance to pay taxes. So that's kind of a creative twist there too, I think, where you could actually do a Roth conversion in conjunction with purchasing life insurance to help maximize the overall tax hit. We also know too that really the crux of this story and what I think sold this case was the long-term care story. And so here you see that there's $31,000 of monthly long-term care benefits that are available from the long-term care rider. And so that not only helps to pay for long-term care, but we know that if a long-term care event occurs, that's actually going to help prevent depletion of the retirement assets and income as well. So that's sort of the legacy, the backstop client, as I think about it. This next example, this one I actually loved. So this was a case that we worked on last year, real case, where we saw a client who was 81 years old. And this case not only highlights, I think, the concept that I'm trying to drive home here around legacy repositioning, but I also think this was a really good case study in engaging with our advanced markets team and some of the resources in our process for how we walk through some of these types of large cases. And so this is a true legacy client. This client was 81 years old. She was a widow, and her husband had passed away in 2020. And so at the time, her husband had elected portability. And back in 2020, the exemption was $10,580,000. And so with that portability election, she has pretty large amount of exemption available for her to use. She has 2 children, and her estate is approximately $18.5 million today. And so this case came to us not as a legacy repositioning case, not as IRA Max. It came to us as a very basic estate tax calculation request. And so we had the question where essentially the advisor called us and said, spoke with one of our attorneys and said, can you help me just really quickly understand what the estate tax liability might be for this client if we assume a growth factor on the estate of X. And so we did that. We put together something really simple as just using Number Cruncher to calculate the estate tax projection. And so that was really, I think, kind of the key to just get the conversation started. Once we started talking more and finding out what the estate was comprised of, and that's sort of my thought process for a lot of these conversations too, is not necessarily dive right into a concept. It's consultative, right? So it's thinking about what's their estate tax planning need. Now, step 2 is what types of assets does the client have? And that's important for 2 reasons. It's important to say, what assets are we working with that can help fund this life insurance need? And then secondly, are there assets inside of that estate that could be optimized or are inefficient for legacy planning purposes? And so in this example, it was the latter, where we started to look and see, okay, you have an $18 million estate, $7 million of that. So, 40% of the estate is comprised of a traditional IRA. And the client also had, I believe, around 10 million in non-qualified assets, and then they had a home. And so obviously, looking at this, that $7 million IRA, assuming a growth factor on that, is going to result in pretty substantial income tax liability because there's no step up in basis on the asset at death. So the client's goals were really to maximize the transfers that the descendants would receive, and they wanted estate tax efficiency. So both income and estate tax efficiency, trying to make sure clients got the most they could, or their loved ones got the most that they could. And then something else that we found out as well during these conversations is that this client was very charitably inclined. So the client had a longstanding pattern of giving to a charity and was interested in using some of their charitable goals to help with some of the planning needs as well. And so as we engaged our team, like I said, they called us at first to just sort of walk through the high level plan. We then brought in one of our advanced markets consultants. And so our team, we have attorneys and consultants on staff, and the consultant ran multiple iterations using our JH Solutions software. We have an IRA optimization or maximization supplemental report. And so that module was really helpful in telling the story. And so that really teed up everything I just covered of why the IRA was not efficient for the client. And we were able to really look and talk about how to position the case most effectively. And the big thing here too, that was also important, was that this was a COI example. So I'm sure many of you are frequently working with CPAs or attorneys. And a lot of times for these strategies to work, you need to have the client's attorney sign off. And in this case, the client's attorney understood there was a planning need for some life insurance, but they questioned how much. They thought that the amount of death benefit that we were looking at was too high. And so this is where engaging our team helped to have that conversation, where we were able to do a number of estate tax projections, show the impact of how portability would play into that, look at making an additional $5 million gift to charity with and without gifting. And then we also were able to position that internally with our financial underwriting liaison in having a conversation with the producer and our underwriter, so that everyone on board felt like the amount of coverage was suitable for the client. And so what happened here was, this was our protection VUL product. The sale actually closed within 4 months of when advanced markets got involved, but this was a target premium on a 81-year-old client. First premium was $600,000, and it was a $340,000 target. So a really nice case. It purchased her $7.7 million of death benefit inside of the ILET. And the other thing here too is, again, remember that $7.7 million of death benefit is going to be received by the trust that now needs to be invested by the trustee, working in conjunction with the client's financial professionals. I find that in a lot of cases, my experience has been, when those situations happen, they go to the family's financial professionals. So if you're already working with them on helping to provide some of that investment advice, that's really a natural fit. And then in this case too, we saw the IRA is basically replaced in an income tax-free creditor protection manner. And it's also estate tax-free because it was received by the ILET. So just a really nice case where it took something, this IRA that the client was never going to need for income needs. We could have kept that in the estate, and that would have been fine. It would be simple. Well, in this case, we were able to actually listen to the client's goals and objectives, work through that, and create something that was a lot more tax efficient. But ultimately, it helped her help her achieve what she was aiming to achieve as it related to her planning. So when we think about planning with IRAs or qualified plans, the options really are endless. It really depends on what the client's planning goals are for what they would want to use those insurance proceeds for. But a traditional problem that you see are increased tax liabilities. So the first scenario, child inheriting an IRA in peak earning years. Perfect example is pre-Secure Act, daughter receives an IRA, takes distributions over her lifetime, and that allows her to manage income taxes. Well, now, as we talked about, the daughter inherits the IRA in peak earning years. Now you have to take distributions over the consolidated 10-year period. Because you're in a peak earning years, that's going to be taxed at the highest state and federal tax rates over the 10-year period. Or even if you weren't already in the top rate, now you probably are. And so what we see here is post-Secure Act, now we can use those death benefit on the participant's life to pay the taxes on the IRA distributions. Or it can be a second bucket of capital that you can use to delay taking distributions and try to preserve the stretch for a little bit longer. So that just really helps with the increased tax liability. The accumulation trust is a similar thing. So an accumulation trust, all that is just a type of trust that allows an RMD to collect inside of the trust, with the trustee having discretionary distributions over distributions to trust beneficiaries. And so under the new law, you're required to distribute that accumulation trust in full under the 10-year rule with those accelerated income tax payments. And so same thing here, the insurance proceeds can be used as a source of liquidity there as well. The second thing we see are repositioning assets too. So you could use the insurance proceeds to provide a lot of flexibility in terms of delaying RMDs, either to delay RMDs until the deceased spouse would have turned 72 or under what will be the law soon, 73 and up to 75, as well as rolling over the plan into the spouse's name and taking RMDs at the survivor's age 73, really. Or the second one is this idea of conversion to a Roth IRA. So if you have a client that wants to take that IRA, convert it to a Roth, and then use insurance proceeds to help cover some of those costs as well, we see that as another option. And then really the biggest story here is this mimicking a stretch. So using life insurance proceeds inside of the trust or outright, depending on the client's needs. Now you're giving the client the control back to direct how insurance proceeds are used instead of the IRS. And I find that's what most clients want. They don't want the IRS to determine that. So we see the life insurance proceeds left inside of a trust for the benefit of children or grandchildren. That trust can have all sorts of provisions depending on the planning goals around lifetime distributions. We could also see the IRA left to a charitable remainder trust to basically simulate a stretch. And so what that would look like is you could leave the IRA to a CRT and use life insurance as a wealth replacement tool. And so the child would be the income beneficiary from the CRT. The charity ultimately benefits as the remainder beneficiary, and then the life insurance can also help to supplement the remainder interest going to charity. And so that allows for you to stretch for longer than 10 years as well. We also see half of the IRA going to a surviving spouse, half going to children, and then using some insurance for liquidity needs there as well. So a lot of different uses for the life insurance in terms of the client's overall plan. But essentially what you're doing is taking something that's very inefficient from a legacy planning perspective and turning it into something that can be used for a variety of needs depending on what the client's objectives are. So just to kind of wrap this one up, and before we get into annuity maxes, I'll just pause for questions. I can't see the chat feature, but client profiles and next steps, that really who we're prospecting to in these types of conversations typically are your clients over age 59. Many times when we're talking about IRA Max, we're already assuming someone's taking RMDs, but you could absolutely take a post 59 and a half distribution that would be taxable to start redeploying funds today. We sometimes can illustrate that as well. Someone who's not needing those RMDs for current needs and was excited about the increased age under Secure 2.0. And if you're looking to really preserve IRA assets, help offset medical costs or long-term care needs, and then do some really meaningful, impactful trust planning with that stretch IRA. So I would encourage you, if you have clients with IRAs, as I'm sure you do, now's a really good time after Secure Act 2.0 to have some of those conversations, get the conversation going. Reevaluating beneficiary designations as well as trusts is really important. So if you have a client that has a trust that was named as the beneficiary of their IRA or qualified plan, in light of the Secure Act, that trust might not be the most appropriate beneficiary designation now, or maybe it is, but either way, it's really, I think, a good time to be having some of those conversations. And then you can look to see if life insurance makes sense as part of that planning. So I don't know if there's any questions before I walk through what we're seeing on the annuity side.
Carly, I do not see any questions. That was terrific. Again, please type your questions, if you've got any, into the chat box or the Q&A button at the bottom of the screen, and we will get to them. So why don't we go into the annuity part of the presentation?
Sure. All right, great. Thank you, Kathy. So Annuity Max. So if IRAs and qualified plans are the worst asset you can leave, then annuities are a close second, deferred annuities. And the reason for this is because you think about what an annuity is purchased for or what it's used for. as people age, their circumstances change. And so we see a number of retirees that own annuities, and they're going to say, I don't actually need those for retirement income. So they bought it for retirement income. They don't actually need it for retirement income. And then when you ask them, well, what are you going to do with that then if you don't need it? What are they going to say? They're typically going to say, well, we'll just leave it to the kids. And so that's what we see sort of in both contexts, but the value of the plan is not always most efficient in that context. So what we're looking at here is, can you take an annuity and create a larger bequest to your kids and grandkids? And if we have the annuitant that can qualify for life insurance, you can basically turn on annuity income to pay premiums on the life insurance policy that way. And so this type of strategy is basically, again, taking something that's not needed for retirement income. And so that's what I call a legacy asset, and repositioning it into something that can be used more efficiently for current income needs. It looks like we have maybe one question. I'm happy to take that as we go from Kim. And hello, Kim. So Kim's question on the IRA was, what are your thoughts on forced distributions from a large IRA? Are you seeing any clients take 72T distributions? So this is a great question. 72T distributions, I do get the question. That's not something that we illustrate or necessarily even support. So I do see it occasionally, but really who we're looking at here are people that are over age 59 and a half to try to take these types of distributions. All right, so moving on to Annuity Max, just a quick example, I think, of how this works and looks. Estate planning with deferred annuities, like I said, is somebody that you're basically taking an unneeded deferred annuity, using it to purchase a life insurance policy. And in many cases, we're also doing this in conjunction with an ILET or with a trust. Life insurance, I think this is one of my colleagues who's actually our variable insurance specialist. He always says, talk about things in threes. And so he calls them the 3 L's of life insurance. I call them the 3 P's: protect, provide, and preserve. And so you think about how life insurance can be used. It's protecting families from financial hardship, economic, income replacement, and things of that nature, providing supplemental income, and then helping to preserve wealth. And so when you think about an annuity that's not needed for current income needs, what we're basically suggesting here is that you could take the full amount of the annuity to fund a life insurance policy, or you could take withdrawals, and there's different options in terms of how we'll structure these types of distributions from the annuity. And so these are the 4 ways that we'll see this typically done. The first is the surrender. So like I said, that's basically taking the full amount on the annuity to fund the policy. You could take partial withdrawals from the annuity to retain some control over it. Converting to a SPIA, that can also help provide some lifetime income that the client can't outlive, and using an income rider too. So that's just this idea of taking the income at a contractually guaranteed rate. And that's a feature that you can add on in some cases. And so when we think about the distribution options that clients have, really any of these is going to reduce the annuity balance, and anything left over is going to go to heirs. And so think about, what have your clients saved? How much will they need to spend? What are the costs of long-term care, and how will that impact their plans? And then can we leverage some of that to purchase life insurance? And so one example that we worked on recently, and one of my colleagues walked through this, was a client that had, and obviously the names we made up here, but had 2 clients that were presumed in the 35% tax bracket, in their 60s, preferred non-smokers, and they have a deferred annuity growing at $750,000 with a basis of $400,000. And so we just assumed this was growing at 3.5%. This client doesn't need that for income needs. And so they purchased it for that, but they'd really rather use this as an inheritance for their kids and their 1 grandchild. And so that annuity, that full balance that you can see from the example, the annuity balance at life expectancy. So if it's worth $750,000 today, if we're assuming that 3.5% growth, there's going to be IRD taxes on those. So you can have it continue to grow tax deferred. And when their heirs, when they die, their heirs will receive the annuity less income taxes. And so it's not necessarily detrimental to do that. But the real concern there is income tax efficiency. And so where you have an asset that is now subject to both income taxes as well as the full remaining annuities subject to estate taxes as well, because there's going to be inclusion in the estate. We don't see annuities owned outside of the estate typically. So that's creating something that is very inefficient from an income tax and an estate tax perspective. And so if you take all of that together, you have the at life expectancy, age 92, the annuity value at the beginning of the year is we'll call it 2 million. At the end of the year, it's 2.1 million. Those IRD taxes are nearly $600,000. And so do you want to be taking $600,000 right off the top? Probably not. Is there a way we can structure this to be more effective, more efficient? And that's where we can also illustrate this idea of taking a withdrawal. And so that withdrawal, in this example, we're going to assume that they're going to take $17,519,000 to pay the premium on a life insurance policy to the client, and that they're going to purchase the survivorship UL. So it's a $1.6 million life insurance policy that they're, repositioning premiums to purchase the policy. And so the gain due to planning here is around $580,000. And that's assuming that the annuity, the premiums are taken each year from the annuity, and that by year 30, you've paid premiums of around $525,000. But now those IRD taxes, because you're drawing down on the annuity, it's been repositioned into a life insurance policy that's received income and estate tax free. You don't have that same income tax liability received at the end of year 30. And so that's really the IRA Max story at a very high level. But I think both of these concepts, why they work, is that you're taking something, again, that is really inefficient for legacy planning, is going to be subject to IRD taxes, and now looking at ways that you can create an asset that offers not only income and potentially estate tax efficiency where you're using an ILET, but also can be really helpful to achieve a lot of other planning needs and goals that the clients are likely to have. So with that, I think we have maybe 10 minutes left. I think the other thing I'll just kind of briefly mention as a plug, I know Wayne said it at the beginning, we have a lot going on at John Hancock. I think right now, it's been sort of an interesting start of the year where we haven't had some of the legislative tailwinds that maybe we've had in the past. I think there's sort of this sentiment that, what are we talking about? What are we hearing about? But where I'm seeing things within advanced markets is that the market's really strong right now. There's so many opportunities for high net worth clients. Clients are concerned around things like income tax efficiency, making sure their plans are protected for a variety of different types of needs. And so I'd actually say there's a lot to be talking about right now. And these two concepts are not just hypothetically resonating. Every example I showed today was a case that we worked on. And I do think that there's a real need for more of these conversations to be happening. And so we have the ability to illustrate these. Again, Agency One can help you get in contact with my team, reach out to Kathy or Gonzalo or the team. You have obviously great partners with them, but Wayne and I are also here to help with any of your needs. So with that, I'm going to maybe stop sharing my screen. And if there's any questions in the last 10 minutes, I'm happy to take those. Let's see.
Carly, thank you. That was terrific. If you have any questions, please type them in the chat. One of the things that's become very clear to me during my tenure at Agency One and previously is, not only are we working with you, the advisors that are on their phone and they're working with their existing clients, but one of the things that we're always mindful of is how do we protect your book of business and basically ensure your legacy so that you're dealing with future generations as well. And, when you think about that from a planning perspective and how you can protect your book of business, there are so many concepts and opportunities out there that not only work, first and foremost to the benefit of your client, but secondarily, just naturally to the benefit of yourself and your legacy. And if you're not planning for, this legacy, then there's going to be another advisor that will come in there and discuss some of these other planning concepts with your clients. So with that, Agency One has a lot to offer. Carly is a phenomenal resource to us. We are hoping, and with this, I'm going to plug our annual meeting, which is at the end of the month, the end of April. So the annual meeting starts April 30th, May 1st, and May 2nd in Washington, D.C. We are hoping that Carly is going to be one of our featured speakers. I'm waiting for her to confirm her availability. But if you have not had the opportunity to attend an Agency One annual meeting, we generally hear that it's one of the best meetings of the year. And you are sure to leave with actionable sales ideas that you can put in place before year end. And we're also going to have a special workshop actually on Wednesday, May 3rd, which just will focus on how to work with centers of influence. And that is going to happen after our meeting ends, our general meeting. So if you'd like information about the annual meeting or how to work more efficiently with referrals and centers of influence, please reach out to myself or Gonzalo. If you would like to register for the annual meeting, reach out to us or to Lisa, or look at any of our signature lines, and there is a registration link on everyone's signature line where you can register for the meeting and get some more information. We may have, nope, we do not have another question. I do not think, oh, Gonzalo. Well, Gonzalo, why don't you come off of mute? If you can. There you go. Thank you.
Welcome. I was just going to state that, annuity sales are growing massively. Certainly as interest rates have gotten higher, I think annuities are breaking all records right now in terms of sales. Especially in the multi-year guarantee annuity and equity index annuities. I believe Cheryl Moore was the one that told me that, less than 1 or 2% of all annuities are actually annuitized for income purposes. And most of these annuities end up getting left to beneficiaries. It's a really, really big mistake because you're giving 40% plus to the government. So a lot of planning opportunities are available right now in this space, especially around annuities, but certainly don't discount the IRA market. And I just want to thank Carly for your words and thank everybody for joining us on this conference.
Absolutely. Good point.
And Wayne, thank you as well. Always, Agency One is always grateful for the support that we get from John Hancock. And with that, if nobody has any other questions, we're going to sign off, give you back at least 6 minutes to the hour. And please look out for the next webinar we'll be hosting and then our annual meeting. And if we can be of any assistance, please reach out to us. Thank you.
Thank you all.
Take care.
Bye-bye.
Thank you.